Okay, let's jump in. You ever look at a pile of financial reports just packed with numbers and wish someone could just, pull out the main story?
Yeah, cut through the noise a bit.
Exactly. That's what we're aiming for today. We're doing a deep dive into some specific source material.
Right. We've been digging into documents that focus on a particular investment strategy. It involves using leveraged ETFs.
Leveraged ETFs. Specifically, the sources we have look at performance data, risk analysis, all centered on a portfolio using SPXL, SSO, QLD, and TQQQ over the last, 10 years or so.
That's right, 2015 up to mid-2025 based on the data provided. And our mission here really is just to unpack what these sources actually say. What insights do they present about how the strategy did, the risks involved according to their analysis, and how suitable they think it is.
Okay, and this is really, really important. We need to be absolutely clear right at the start. What we're talking about today is purely an analysis of the information presented in the source material we were given. Okay, we're just trying to understand what's in these documents.
Exactly.
This is not investment advice, not in any way, shape, or form. Don't take it as a recommendation, please. We're just exploring the information itself.
Think of it like we're summarizing a report someone else wrote. We're not endorsing it, not telling you what to do with it, just laying out what it contains.
Perfect.
Yeah.
So, with that very clear line drawn, let's get into it. What are these leveraged ETFs, according to how the source material explains them?
Well, the sources define them as funds, specifically designed to amplify the daily returns of whatever index they track, like the S&P 500 or the NASDAQ 100.
Daily returns, that seems key.
It's crucial. They use derivatives, complex financial tools to try and hit a target multiple, like, say, 2 times or 3 times the index's performance, but just for that one day.
And the specific ones the source analyzes track those big indexes, right?
Yeah.
SPXL is 3x the S&P 500 daily. SSO is 2x S&P 500.
And then QLD is 2x the NASDAQ 100 daily, and TQQQ aims for 3x the NASDAQ 100 daily.
Got it. So the strategy itself, as laid out in the source, what does that look like?
The hypothetical scenario presented starts with $100,000, and the idea is you put 25% into each of those 4 ETFs, so an equal split.
Okay, simple enough start.
And then the analysis assumes that portfolio is rebalanced once a year back to that 25% allocation for each one.
Right, to maintain the equal weighting.
Mm-hmm.
And they track this hypothetical portfolio over a pretty wild period start of 2015 through June 2025.
Yeah, using the historical market data for that specific time frame, as the report notes.
All right, let's dig into the performance table that's in the source. You start with $100 in 2015. What's the journey look like according to these numbers?
Well, it's definitely a journey with some serious peaks and valleys. It really highlights both sides of leverage. The first couple of years, 2015 and 2016, they were positive, 7.17% and 20.75% respectively. Decent, but nothing too crazy yet. The portfolio grew to about $129,000.
Okay, steady start. But then the source points to some years where things really took off, right? Amplifying those bull market runs.
Oh, yeah. 2017, according to the table, jumps out with a huge return, 69.13%. And then, get this, 2019 shows a return of exactly 100%. Doubled the money in 1 year, bringing the hypothetical value up to $360,000.
100%, that's something.
It is. And even 2020, which had that big COVID dip early on, the strategy finished up 54.62% for the year, according to this analysis.
So you can really see the power of compounding when the market's trending strongly upwards and you've got that leverage working for you.
Absolutely. By the end of 2021, after another massive year, 74.08% return, the source shows the portfolio value rocketing past $970,000.
From a $100 case starting in 2015, incredible on paper.
And the recent years in the table continue that trend, mostly. 2023 delivered 85.58%, and 2024 added another 67.25%.
Right.
By the end of last year, the value shown was over $1.2 million.
Okay, so if you only looked at those years, you'd think this was some kind of magic bullet. But the source material immediately slams on the brakes, doesn't it? It dives right into the drawdowns.
It has to. That's the other equally important side of the story. The analysis doesn't shy away from showing how leverage cuts both ways, hard. The first real taste of that in the period shown was 2018.
Right. The table shows a negative 17.65% return for the portfolio that year, minus 17%.
And the source analysis attributes this to a broad market correction. But the key is that the loss was amplified by the leverage. You see the portfolio value dip from around $218,000 back down to $180,000.
A significant hit, but recoverable given the subsequent years. But then, 2022.
Yeah. 2022 is the year the source really focuses on to illustrate the risk. The reported return for the portfolio, minus 59.9%.
Oof. Almost 60% wiped out in 12 months.
That figure is central to the source's risk assessment. They explicitly state this reflects a major bear market hitting both the S&P and the NASDAQ, and the leverage just magnified those losses tremendously. Think about it, the portfolio value shown plummeted from over $970,000 at the end of 21 down to just $389,000 by the end of 22.
That's a brutal swing. It really drives home how quickly things can reverse.
It really does. And the source also gives the year-to-date figure for 2025 as of June. It shows return of negative 7.83%, bringing the value to around $1.11 million.
Okay. The source also mentions the estimated key GRs, the compound annual growth rates, for the individual ETFs over the 10 years.
Yeah, it provides estimates. For SPXL, it's around 23% annually. For TQQQ, it's even higher, maybe 32%. The 2X funds, SSO and QLD, are shown somewhere in between the index itself and the 3X funds. But, the source implies these smoother TGR numbers kind of hide the absolutely wild ride shown in those year-by-year returns.
Right. The average doesn't tell you about nearly losing 60% in 1 year. Okay, so the data shows this incredible potential upside, married to just gut-wrenching downside potential. Let's shift now from what the numbers show to why, based on the analysis sections in the source.
Okay, so the analysis circles back to the core mechanism. Yes, you can get these super high returns like 70% or 100% in a year if you have strong, consistent trending bull markets. That's leverage doing its job on the way up.
Yeah.
But, and this is the huge caveat stressed throughout the source material, you have amplified risks and drawdowns. The leverage works just as powerfully in reverse.
It magnifies the losses, too.
Exactly. The source emphasizes that the big drops seen in 2018, and especially that devastating 2022, aren't flukes. They are the direct expected consequence of using leverage when the market turns down. Even a, say, modest dip in the index can translate into a very large percentage loss for the leveraged ETF itself on any given day, and that compounds.
Which leads into another concept. The source brings up something called volatility drag, or variance strain. How do they explain that?
Right. The report explains that because these ETFs reset their leverage every day, that 2x or 3x multiple only really applies precisely to that single day's move.
Okay.
So over longer stretches, especially if the market is choppy going up one day, down the next, up a bit, down a lot, the actual performance of the fund can end up being much worse than just, say, 3 times the index's total return over that whole period.
So the path matters, not just the start and end points. The daily ups and downs, because they're magnified, create this drag.
Precisely. The volatility itself sort of grinds down the returns over time compared to what you might intuitively expect. It's a mathematical effect of the daily compounding and resetting.
That sounds important for anyone thinking long term.
Extremely. And because of this volatility drag, plus the daily reset, the source material is quite blunt in its conclusion here. These products are not designed for long-term holding.
Okay, that seems like a really critical finding from their analysis, not buy and hold.
Definitely. The source positions them as tools primarily for short-term tactical trading. The volatility drag, plus usually higher expense ratios compared to standard index funds, tend to eat away at long-term performance potential.
Does the source say anything about the diversification in this specific strategy, holding 4 different leverage ETFs? Does that help?
It does mention that diversifying across several leveraged ETF, like in this 4-fund example, and doing that annual rebalancing, can potentially moderate the risk somewhat compared to just putting everything in, say, TQQQ. But the source is very clear. The overall portfolio, even diversified like this, still carries exceptionally high risk. It doesn't fundamentally change the leveraged nature of the holdings.
Which ties into what the source says about suitability, I imagine.
Exactly. The analysis explicitly states these ETFs are not suitable for most investors, particularly those who are long-term focused or have a conservative risk profile.
Needs a strong stomach, sounds like.
That, and a very deep understanding of how they work and the risks involved. The source analysis implies you need a really high tolerance for volatility, and you have to be genuinely prepared for the possibility of those severe losses, like the 2022 example. It even notes that regulators and experts often caution against using these for, like, your core retirement savings.
Okay, that paints a pretty clear picture of the inherent nature and risks according to the source. But the report apparently also tackles a very practical question. What about using just a small slice? Like, could someone put, say, 10% of their portfolio into this kind of strategy?
Yeah, the source addresses that directly. And its answer is, well, consistent with the rest of the analysis. It's basically, Yes, maybe, but only with extreme caution.
Extreme caution. That phrase keeps coming up.
It really does. The source lays out some very strict conditions under which even considering a small allocation might make sense based on its risk findings. The investor absolutely must fully grasp the amplified risks. We're talking potential 60% drawdowns, remember. They need that high risk tolerance we mentioned, and they have to be mentally and financially prepared for significant volatility and potential losses.
So just because it's only 10% doesn't mean the risks within that 10% are any less severe, according to the source. It just limits the damage to the overall portfolio value if things go south.
That's the implication, and the source clarifies how you should think about that 10% allocation. It's purely speculative or tactical. It should not be seen as a core, foundational part of your long-term plan.
Makes sense.
And the analysis stresses you have to size it appropriately, meaning even if that entire 10% were somehow lost, which the source presents as a real risk to consider, it shouldn't derail your main financial goals.
That's a pretty stark warning embedded in the guidance. Plan for the worst-case scenario with that slice.
And it requires ongoing work, according to the report, rigorous risk management. That means watching it closely, rebalancing it maybe more actively than just annually if needed, and being ready to cut back or get out entirely if market conditions get really choppy or things start heading south significantly. It's not a set-and-forget allocation.
So the source essentially summarizes its view on this 10% idea pretty tightly at the end, doesn't it?
Yes, there's a concluding statement in the report that captures it well. It says, let me find the exact wording here. Leveraged ETFs can offer significant gains in trending markets, but their amplified losses, volatility drag, and unsuitability for long-term holding make them risky. A modest allocation, such as 10%, may be appropriate for experienced risk-tolerant investors seeking tactical exposure, but they should not form the core of a long-term portfolio.
That sums it up pretty well, based on everything else we've discussed from the source.
Yeah, it hits all the key points from their analysis. The allure of the gains, the harsh reality of the losses and the volatility drag, and the strong caution against using them long-term or as a core holding for most people.
Okay, so if we just stick purely to what the source material we analyzed today presents, the picture is, well, it's dramatic. This hypothetical strategy showed how you could potentially turn a $100 K into over $1 million in favorable markets.
Huge potential upside shown in the data.
But it also showed you could lose almost 60% of your money in a single bad year, like 2022. And the underlying analysis in the source just keeps hammering home that these are specialized tools with built-in issues like volatility drag, making them generally unsuitable for typical long-term buy and hold investing according to their findings.
Right. Even a small allocation requires, based on the source, a really sophisticated understanding of risk and a very high tolerance for potentially painful swings.
It's a stark reminder from the data that not all investment products are designed for the same goals or the same people.
Definitely not.
Which kind of leads to a final thought for you, the listener, maybe something to mull over after hearing this breakdown of the source material. When you see performance data like this, the incredible highs, right next to those crushing lows, and you factor in the mechanics like that daily reset and volatility drag, does it maybe make you think differently about what risk tolerance actually means in practice? And maybe question what makes an investment truly long-term? Knowing that some tools, according to this analysis at least, just aren't built for that journey, it really highlights how crucial it seems to be to, understand the specific tool you're using, not just the potential outcome.
That's a really good point to reflect on based on what's in these documents.
Definitely food for thought. And just to say it one last time, please remember everything discussed here was our attempt to accurately summarize and analyze the specific source material provided to us.
Nothing more.
It is absolutely not investment advice. We're not recommending anything, just exploring the information presented in the reports.
Just laying out what the source has said.